Over the last couple of years, a lot of people have come to me asking a question about something that I think they've seen on the internet called private banking. Some call it private pension plan. Bottom line is it's really about having a source where you can take advantage of certain specific federal income tax laws and the advantage of products issued by life insurance companies that will allow you to accumulate money on a preferred basis, borrow the money on a tax-free basis, and still be able to provide a death benefit. The concepts are really coming from two places, tax law and insurance law. And over the next couple of minutes, let's talk about that, just so you'll be familiar about what this concept is really all about. Before we get into the main parts of this seminar, I just want to give you a little bit of background about myself.
Born and raised in New Jersey, he grew up in Somerset, where he graduated from Franklin High School. He attended North Carolina Central University, where he earned a BA degree in history with a minor in political science. He received a master's degree in teaching from Montclair State University. He has received the CLU designation from the American College and the CHFC designation from the same school.
Al Rush serves as president of A. Rush & Company. Al entered the financial services industry in 1974. Prior to assuming this role, he held positions as sales manager of Phoenix Mutual Life and Pepco Equity Sales Corporation, and as manager and director of equities for Olney Hewson, Inc., a financial planning firm headquartered in New York.
I want to teach you how to become your own bank. Forget groveling to Wells Fargo when you need a home or car loan. Don't run to JP Morgan or Bank of America and get on bended knee to beg for a loan to buy a business. Take control of your life. It's time to start the bank of you.
Did you know that every dollar you put in a traditional bank is one less dollar that you can use to truly build wealth? Having your money in a traditional bank is a terrible financial deal because you get next to zero interest, while the bank leverages your money to make more money hand over fist. But there is a safe asset that offers exponentially more interest, but also, number one, guarantees growth. Number two, pays dividends. Number three, offers tax-free compound growth. Number four, access your growth cash savings tax-free. And number five, provides a leveraged death benefit.
Nelson Nash is credited as being the inventor or creator of the infinite banking concept. Robert Nelson, PhD, an economist, talks about his introduction to the private banking concept and to Nelson Nash.
And he was working on a presentation that he was giving to commercial bankers on how fractional reserve banking works, and Carlos just really wanted to make sure he, had his ducks in a row. And he saw on the back of this study guide that I had written that I also was from Nashville, so he invited me over, and I get over there, and then at some point, as we got to know each other better, he hands me Nelson's book, and he says, "Hey, Bob, I want you to look at this thing. Tell me what you think, because this really, made an impact on me." But he didn't say too much more about that. It was more of an open-ended question. So I took it, went home with it, and my initial reaction was along the lines of, this guy Nelson Nash sounds like a great guy. Like, you want to go have a beer with him. He's got a lot of wisdom. I love him as a character. But sorry, there's like 5 things wrong with this book. Like, seriously, serious fundamental problems. And I'll be honest, if I didn't know who Carlos was and I didn't know who Nelson was, like if somebody had just mailed me that book, I would have put it aside and I never would have come back to it. I just would have thought, nah, there's something weird there. But it was because I knew Carlos well at that point and trusted his judgment, and he thought so highly of this guy, Nelson Nash, and this concept, that I stuck with it. I didn't just reject it. And the more I got to learn about how whole life insurance worked and more about what Nelson actually meant, it was like, okay, actually there's only 4 things wrong with this concept. And then a lot more I learned, I was like, you know what, 3 things wrong. I misunderstood that other piece. And of course you can see where this is going. It got whittled down to finally I was sold, and I was thinking, how come not everyone's doing this? This is obvious. So it was that sort of thing. And I think the fundamental thing was that I didn't know how whole life worked, and then also that I misunderstood a lot of what Nelson was saying. And as Nelson would probably put it, like my training, my PhD in conventional economics, it sort of made me think of it a certain way. And so there was a paradigm shift that was necessary.
There are two underlying concepts involved in this. Number one, that you pay for everything you buy, either in cash or by loan. Number two, life insurance policies offer you an opportunity unique because you can accumulate money in those contracts on a tax-free basis and take money out of them tax-free by using policy loans.
Step 1. Capitalization. Set up a properly designed whole life insurance policy focused on maximizing cash value accumulation. When properly funding a policy, the cash value account grows quickly, and you have access to cash value typically within a month of starting your policy. Step 2. When designing your policy, make sure you have the correct amount of your premium going towards the base and towards paid-up additions. This drastically reduces commissions paid to the agent, and you want a policy that has the minimum amount in base premium with the majority of the cash going into paid-up additions. Step 3. Fund your bank by putting as much cash into your policy as possible without the policy becoming a modified endowment contract, or MAC. One of our experienced life insurance professionals will be able to guide you here. Step 4. Finance your purchases. You use the cash value in your policy as collateral for a life insurance policy loan. You then use the funds from the insurance company to purchase cash flowing assets. One great cash flow asset is real estate because it creates cash flow and offers tax incentives. As you use your policy loan to make a down payment on an investment property, you can then use your monthly cash flow from the property to pay back your policy loan with interest. Step 5. Recapture your money. As you pay back your loan, your cash value account is still growing through interest and dividends with true compound interest because the entire balance is still in your cash value account. Step 6. Repeat the process again and again. The key to successfully using life insurance as your own banking system is to borrow against your cash value, purchase cash flowing assets, then pay yourself back by repaying the loan. So you are essentially making money in two places with the same money. Your investment is making money, and you are getting a true compound interest return in your policy.
When considering the private banking, private pension, or infinite bank, the details right now aren't as important as understanding the concept. The concept very simply is you set aside money in a life insurance policy issued by a reputable life insurance company. You structure it in such a way that the emphasis is placed on the development of cash, and later on you use that developed cash to purchase items, and then you use the income from those items to repay the loan, and then you're in a position to continually replenish the contract and reapply the income, the assets, to whatever you need to buy into the future. Use the QR code that you see on the screen, and you can reach out to me if you want to get a detailed discussion or example of how this private banking system might work for you. Just keep in mind, the younger you are, the better it'll work. But the news for you, in case you don't know, you're not going to get any younger. Thanks a lot. Talk to you then. Bye.